Hi, my name is Beryl. This video I will introduction Woolworths Group Limited. Woolworths Group Limited is an Australian stock exchange listed multi-option retailer which opened its first general store in Sydney in 1924. Woolworths has six business segments, including Australian foods and petrol, New Zealand supermarket, general merchandise, home improvement, and hotel. As at March 2019, Woolworths has a market cap of 43,264 million with a market price of 32.48 and the total share is 1,317. Let's talk about the corporate governance of Woolworths. The current executive teams and board headed by Gordon Cairns and Brian Bandage. Brian was appointed by CEO of the group in February 2016. The independent chairman, Gordon, was appointed on September 2015. In board of directors, there are total 7 directors, including 3 male directors and 4 female directors. The directors of the companies will attend at boards and committees meeting for 12 times during the financial period. In ownership structure, their investment funds hold 74% of ownership, institute holds 26%, insider just occupy 0.03%, and individuals occupy 0.11% of ownership.
We can see on this picture, in the Standard & Poor's and Moody's rating, Woolworths both rating is BBB. In the risk and return path, the regression of Woolworths stock price against return of the market. It shows Woolworths has less volatile than the market. The beta regression was utilized as the market over the past 5 years has been too volatile to make assumptions about the future financial climate. Analyzing stock price performance using JSON Alpha. It indicates that the stock in terms of excess return did worse than CAMP expected by minus 0.318, as the intercept of minus 0.318 smaller than the practice intercept of 1.074. Both measures indicate that Woolworths performs in surface the market on a risk-adjusted basis. Over the last 5 years, the return on equity of Woolworths has steadily decreased from around 27% in 2014, decreased to 21%. While we forecast the leverage of Woolworths to fall in the periods ahead, driven further up by continuous cost minimizing programs in all segments.
Woolworths Limited is affected by a number of economic factors due to the diverse nature of its operation. We can see Woolworths take the highest market share, about 37%, and it has only one large competitor, West. West take the 33% market share. And these two companies follow the same business model and operate with the same industry. West operations are more exposed to earning volatile due to its interest in the mining industry. Porter's 5-focus analysis shows that the industry is relatively attractive for established players in the industry. Higher entry barrier into the industry, such as the high level of required capital investment and economics of scale in the forms of an optimized supply chain network, reduce the threat of entries by competitors. In the Woolworths current financing, Woolworths has constant its debt level by about 2.9 billion over the last 12 months, which accounts for long-term debt. And at this constant level of debt, Woolworths currently has 1.6 billion remaining in cash and short-term debt. This is ready to be used for running the business. On top of this, Woolworths has produced 3 billion in operating cash flow in the last 12 months, leading to operating cash to total debt ratio of 103%. It means that Woolworths operating cash is sufficient to cover its debt. With debt at 25% of equity, Woolworths may be thought of as appropriate leverage. This range is considered safe as Woolworths is not taking too much debt obligation, which can be restrictive and risky for equity holders. In historical dividend policy, the dividend yield is the dividend per share relative to the share price. The 12 months dividend yield is 3.18%. Management tried to strike a balance between shareholders' return and ensuring adequate capital is retained for the growth of the business to maximize long-term shareholders' value.
This graph shows that Woolworths has higher dividend payout ratio compared to the industry average, with dividend yield is nearly equal to the industry average. The average dividend payout ratio of the peer group is more than 50%, which means that over the half of their earnings are paid out to investors through a dividend. Woolworths has lower EPS compared to the peer group. It suggests that it can increase through share repurchase. Hence, Woolworths has a higher ROE than its peer. It can explain that the dividend payout ratio is significantly higher than the competitor.
In conclusion, Woolworths Limited as the second largest company in Australia by revenues has an advanced position in industry. We initial coverage of Woolworths with a hold recommendation. Based on above analysis, Woolworths is source investment, strong future group prospects, and maybe would be the great additional to be a well-diversified investment portfolio. That's all my presentation. Thanks for watching.